Welcome back to the Trading Justice Podcast. It is election week, in case you missed one of the 8 billion ads and news articles over the last few months. We're going to help prep you for election week. We have a very interesting thought exercise. Goldman Sachs put out a number of expected week after moves in different areas of the market, depending on who wins, from energy to semiconductors to banks. We're going to give our thoughts, break down those numbers, help you prepare for maybe some trades after the election. We're going to break down the action from last week. And Matt, in the newsletter, you had a couple of very interesting technical points that we'll discuss here in a second. But that Tackle Trading newsletter is a fantastic part of the pro membership we have at Tackle Trading. Go to tackletrading.com, sign up for that 15-day free trial. Matt, what's your big takeaways from the newsletter? And I know you're excited. I know you're jazzed for the election.
I think like most Americans, I'm excited for the election. I think I'm most excited for the election to be over.
You're basically the average American.
Yes. And Mark, I think like you and 98.38% of the population is a little sick of the political advertising. No doubt about that. Text messages, emails, phone calls, man, it is just overwhelming, no doubt. But
Matt, I got about 14 text messages from whoever the past owner of this phone number was.
I've got like 38 just in the last minute. It's crazy. It's nasty. But I'm excited for the election to happen and to get over. But I'm always excited for the newsletter and for our pro member community to get a very detailed understanding of exactly what's happening in the market on a week in, week out basis. And if you don't mind, just let me take a moment just to kind of explain kind of what goes in the newsletter so that new pro members that have an understanding of the importance of the newsletter, but also, people that maybe are searching for a community like trading communities, want to give Tackle Trading a try. Understand that the newsletter is one of those products that we just absolutely love in our pro membership. It's released every Friday afternoon. And in the newsletter, there's 5 sections. You have the technical update, you have the earnings update, and obviously that was a big one this week. You have the overall sector rankings and understanding kind of what sectors are starting to turn bullish, what sectors are starting to turn bearish. You have an economic landscape part of it where you have an understanding of exactly what's happening from an economic perspective on a day in, week out basis. And then obviously we summarize the global markets at the end of every newsletter. And it's not just the written portions and the analysis. And we obviously, we put the education in application in everything we do at Tackle Trading. And we want to educate through our newsletter as well. And so instead of just giving people, a trade here in the Traders Report, we give people the not only the logic and the ideas, but we also give in great detail in explaining those concepts as well. One quick point in the newsletter: there's actually 2 Traders Reports for Tackle Trading. The Traders Report is our watch list on a week in, week out basis. So lay of the land, macro analysis, top down approach in the newsletter, but in the Traders Report, it's all about application. Understanding, okay, what are the best technical setups every single week on the bull side? What are the best technical setups every week on the bear side? We do a couple videos to explain a strategy of the week, for example. Coach Greg does a wonderful job. And then obviously Coach Frank does a wonderful job breaking down all of these charts in the Traders Report every single week as well. So just wanted to spend a couple moments at the first of the podcast here, just explaining those Traders Reports that we release every single week. And if you want to get access to those reports, best way to do that is just to sign up for a free 15-day trial at tackletrading.com. Hit the link in the description.
All right, I want to talk about a couple technical points. Obviously, we had a breakdown from support this week in the broad markets, right? It was and we'll talk about this probably a little bit more in stocks in the news as I bring up a couple Mag 7 of stocks to discuss. But whatever the catalyst was, and let's save that, we had a volatile day. Now, there were a couple of interesting points that from the newsletter. As a consumer, I read it, write part of it, but I read it part of it as a consumer, as you write the technical, that I found very, very interesting. One, when you break a support level, let's talk about this one first. This has always been the case, but it is probably more the case now than it was even 10 years ago, 5 years ago, as algorithmic trading becomes really intense sometimes during any specific day. You break one support level, you go find the next one. And that's exactly what we saw. Talk about that concept for a second.
Well, and this has been a tried and true understanding of technical analysis since the very dawn of technical analysis, that when you violate a support level in the market, the probability shifts to going down to the next support level. The difference in modern markets and specifically algorithm-based markets, which our markets are, the speed is just something that's much quicker than in previous editions of the market history. So when you're talking about that concept of violating one support level and immediately goes down to the next support level, that is true. And it's also true that there is a tremendous amount of different ways to evaluate where support is. And so it's really not just a matter of one technique versus the other. It's really understanding where the true nature of support is. And so understanding moving averages can act as support, significant whole numbers can act as support. Obviously, Fibonacci retracement levels can act as support. Trend lines can act as support. There's 5-6 different ways of but defining where support is. And so the first question on that, Mark, is, okay, where is support? And in the market up until this week, you could really kind of just say, okay, right against that 20-period moving average. You'd see the market come down multiple times against that level, against that 20-period moving average. But there's a concept that we teach at Tackle Trading called stacking support, meaning, okay, is it just one support level? Is that a minor support level? Is it an intermediate support level? How much support is actually there? And so when you look at it from, for example, if you draw some trend lines, for example, you can kind of get an understanding of what I'm talking about. You see, you can draw a trend line connecting the valleys of this current trend, and that kind of converged right there without where that 20-period moving average was. You look at the current momentum of the market, you see that kind of converge right where that 20-period moving average was. And so when you're looking at the violation of support in any market, in any condition, in any time frame, it's not just a matter of, okay, I anchor against the 20-period moving average, and once that gets violated, it's going to immediately go down to 50. Yes, did that occur this time? Absolutely. But that just so happened to be kind of where the analysis kind of led this week. But the concept rings true. You violate support, it's a quick journey down to the next support. And then depending on the volatility, you obviously want to see that play out, meaning settle down, settle in, give you a better understanding of exactly where the damage is in the market. But at the end of the day, yeah, Mark, those are technical concepts that, were taught to me by my technical mentors, and what I teach all of our students as well is understand where support is. And if this level is violated, where is the next level of support? And I think you could look at the market right now the exact same way. When you're looking at the market kind of at the 50-period moving average this week versus last week at the 20-period moving average. And that's where I really kind of detailed in the newsletter the strength of that 50-period moving average, looking at it from a multiple time frame perspective, because you're not just seeing support getting violated on the daily chart. You also saw, obviously when support gets violated, you start thinking about the longer term chart. And when you're thinking about the longer term chart, you go to the weekly chart. All right, so what happened? Well, when you violated short-term support, it just came down into that daily 50-period moving average combination, the 9 weekly moving average. And so you're looking at that 50-period moving average now in conjunction with the 9 EMA on the weekly chart, and you're saying, all right, now we're at support again, right? We're at support again. And you're going to go through that same process, because if support gets violated this week against the 50 and against the 9, I'm pretty certain you can line yourself up for another quick journey down, another 10 points down to the next level of support, which is clearly a pocket on the moving averages. And so,
yeah, and that's
very important concept, though.
This exercise is very important. It is something I do in my Cash Flow Vikings trading lab every week before the market. I'm like, all right, so the structural support is like, all right, where's the next potential bounce area, or are we already there, right? Just, it's just a very common exercise that traders do. And I mean, we're at a place where this might be the sell-off, right? You see intraday support levels form up here, right? Heading into the election, lift off. This might be the extent of it. And then you go through and be like, all right, if I get a support break, where's that next one, right? And it's just a very important exercise from technical analysis.
It's also a concept we kind of explain in this is not a technical concept, more just how we explain kind of the price movements, but a volatility pocket.
Yes.
And they occur in earnings season when you get, a tremendous amount of volume coming into the market on catalyst type driven news. You can see fairly aggressive and sizable moves in the market in the short term. But I want to be very clear on something. It doesn't mean that you're going to see the next support level get violated. If this is just a volatility pocket and you had that moment in time where the market just gave support, algorithms took over, then it's a matter of what happens next. And that's what was the newsletter was really about this week. And the technical update was, all right, now that we understand kind of what occurred last week, what do we need to see next? What do we need to see improve so that we can get a little bit more confidence on the technical side of the market?
Yeah, no, the other interesting little tidbit that I really enjoyed was how quickly you got into near oversold conditions. Now, this is the speed in which this has happened in recent months on sell-offs. We saw this most pronounced in July, where in just a few trading sessions, you went from overbought to oversold. The speed of this one is pretty shocking.
It's the fastest one we've seen in a long time.
And this was an excellent catch by you in the newsletter, because what it does when you go from higher to an immediate,
you're oversold in a fundamentally decent condition. Those are usually turns out to be buying opportunities.
It makes me even extra want to pay to those intraday support levels of the form. Now, can you go even more oversold? That's why you pay attention to intraday support level, but it sets the condition. There's a phrase I use: conditions to crash. These are conditions to bounce.
Right? It sets the condition for the next bounce to be larger than the previous upward move in price is what it does. And
over the last 3 months, some of the strongest moves have come off selling conditions, right? Like, it seems like when the market, after they move, they trudge, they fight.
Well, I want to be very clear on something very quickly. In the newsletter, I said this multiple times, as I was breaking down the indicator part of the analysis, looking at the market this week and talking about RSI, talking about MACD, both MACD and RSI are giving sell signals right now. And I started off my conversation with that. Both of these are giving sell-offs. Both of these are showing you, bearish type movements, but they're also showing us something else, because if this was if A then B scenario, if A, this is a volatility pocket and not something more concerning in the market, then you're talking about a 1-2 day pullback scenario in the market where now you're oversold. When was the last time you saw a 1 to 2, 3 day pullback in the market where you're oversold against a bullish uptrend?
I sat back in my chair when I was reading this, and I was like, this is an excellent point, right? Like, if Armageddon doesn't happen in the next few days, starting off,
rally could be substantial.
The rally could be substantial because of how quick this move was down. I thought it was an excellent point. Now, I did have coming up here, you say something as long as...
can I be clear on that?
Yeah,
on the RSI side of it? Because again, I want to be on the RSI and MACD, they are giving sell signals right now. But the point was this: RSI and MACD are lagging indicators. And if you understand how price works, if support builds here after that volatility pocket, you're now going to have an undervalued environment against a technical support bounce in a bullish uptrend. That's a 1-2 punch technically that you don't always see in a bullish uptrend. And so it first starts with support getting built around that 50-period moving average. We have a test against that 50. We have a test against the 90 EMA. We don't have confirmation. And so you got to watch that. You got to let that slow down, no doubt. And that might take a few days. But at the end of the day, if support holds, you're talking about an undervalued situation against a support bounce in a larger, greater uptrend. Mark, just to be clear, the last time we saw the market go down about 20% in the spiders, the RSI went from overbought at 80 down to about oversold at 22, and it took about 3 weeks to do it. In that same go around this time, it took 2 days, and we're still oversold here. It's something that does stand out, and we're obviously waiting on a hook. We're obviously waiting on the MACD histogram to show slowing momentum. But again, it is a 1-2 situation technically that you should keep your eye on, especially if this is just a volatility pocket and support ends up holding here.
Yeah, and not to belabor the next couple points, because there was something you said is like, all right, so it's not a bad setup from a technical perspective. Get intraday confirmation, and guess what? A couple days sideways, that puts you on election night into Wednesday, right? So it's not a bad setup going into the election. Now it's just, can anything cause spook, cause fear in the market? There were three things heading into last week that kind of on my mind. Yields, right? That is still a conversation. That 10-year yield will not calm down. We're going to talk about yields more in the election part of our discussion here in the podcast. So I'm not going to belabor that. I'm going to save that for that. Election uncertainty. Is there going to be chaos in the street? I know David Rosenberg, I saw, something he said is like, listen, I expect uncertainty to last maybe, but we could also know the winner of this and be settled in 24 hours. A lot of variables there. And then was there a negative earnings, theme that emerged from this week a week? And that's what I want to spend a few, minutes on here. And we'll talk about election stuff and yields a little bit later in the podcast. But Matt, we had a bunch of big significant companies report earnings this week. We had a lot of companies in general. Following you each and every day in the Tackle Today and in the Traders Lounge, I didn't see a negative earnings thing.
No, I mean, there were some negative earnings and there were certainly negative market reactions to earnings, but it was a big week of earnings. There was over 167 S&P 500 companies reporting earnings. There was 5 of the 7 Mag 7 components reporting earnings, and there was the vast majority of the growth reporting earnings in the S&P 500 this past week. And it's hard to describe the technical side of the equation without understanding the causation for the technical side of the equation. And when you are looking at that gap down on Thursday morning, and obviously the overnight action was selling on Wednesday night, came into Thursday's cash open, market opened up down under support, and then obviously a very negative cash open on the intraday side of the equation brought that market all the way down to the 50-period moving average. And when you look at a sizable movement like that against the marketplace, gap down, sell down, and it wasn't just the spiders, obviously we saw it on the NASDAQ as well. You're going to ask the question, well, what caused the market to gap and run like that? Because that is a change of behavior. There's no doubt about that. Well, Wednesday night, you had 2 major reports coming out of Microsoft and Meta. And although I'm not going to go through them in detail, check out the newsletter. And obviously we do that every single day in the Traders Lounge for our pro members at Tackle Trading. But in general, Mark, I would say that you had some concern out of Microsoft and you had some concern out of Meta. The concern out of Microsoft was a slight, and I do mean slight, drop in forward-looking guidance for the fourth quarter, specifically on the revenue side of the equation. But Microsoft was beats across the board, and the growth metrics out of Microsoft were actually really, really decent, with over 30% growth coming out of Azure, which is kind of that cloud-based and a very important growth metric for Microsoft. I would describe Microsoft, for example, as a B- type of report, given the fact that they did gap down and sell based on that drop in forward-looking guidance. There was another concern out of Microsoft that was confirmed coming out of Meta, and that concern was, quite frankly, specifically that Microsoft was increasing CapEx spending. And then when Meta released earnings report, they came out with beats on EPS, beats on revenue, forward-looking guidance was fine on Meta. But on the guidance side of the equation, they showed a significantly increasing CapEx spending on both out of Microsoft and out of Meta on the AI build out, the AI infrastructure build out. And that was enough in terms of that lack of efficiency. I'll describe it maybe out of Meta specifically. That CapEx spending concern that Meta and Microsoft were spending too much money was enough just to bring it down. Now, that's the context for what drove the market on Wednesday, why we dealt with the gap down. Earlier in the week, you had AMD. They also reported earnings that came in line. but a high valuation growth stocks, they just can't report in line or they're going to get smoked. You got to impress to justify the valuation. AMD didn't do that. That sent a little bit of a shock, but not big enough in the marketplace. It really was Meta and Microsoft. Now, on Thursday night, we had Apple and Amazon, right? And when we got Apple and Amazon, all of a sudden, Apple gapped down, Apple gapped up, Amazon gapped up, Apple gapped down a little bit. Both on beats on both EPS and revenue. I didn't think Amazon's report was bad. I didn't think Apple's report was bad. I didn't think Meta's, Microsoft report was bad. And quite frankly, Google was just a downright stud on that. The thing that I am a little confused about with the market regarding the AI build out right now, that the market is showing a little bit of concern for on the CapEx spending side of the equation. Mark, this is not a new conversation for the market. It's not a new conversation for growth. It's not a new conversation for semiconductors. It's not a new conversation in the NASDAQ areas of the market. Last quarter, there was concern after Taiwan Semiconductors not raising guidance and after ASML lowered guidance last quarter, that Microsoft, Meta, Apple, Google, these big dog companies that were driving the AI revolution, the AI build out through their CapEx spending, that they were going to start slowing down on their CapEx spending. And that sent the market not down one day, Mark. That sent the market down for 3 consecutive weeks. And we saw a massive volatility spike in the marketplace. It violated every degree of support. And everybody and their dog is like, well, if Meta and Google and Microsoft are going to slow down, that's going to slow down the entire build out. That's going to slow down the entire marketplace. And we're going to have to price in that concern. Well, now it's the opposite, Mark. Now it's the complete polar opposite, with the market coming out here this week and saying, oh, we're concerned that Meta and Microsoft and Apple and Amazon and Google are spending a little too much on the CapEx side of the equation. And so we're going to have to be a little concerned. I don't buy that.
I don't buy it at all. I don't think that had
any capacity. I think it's Wall Street, and I think it's financial media, and I think it's the institutions trying to describe price action. I do not buy that fundamental argument. And that's why I keep saying volatility pocket, Mark, because I just don't buy into we're concerned of Mag 7 because they're going to spend too much money on the build out. Number one, they got the money to do it. Number two, it is absolutely required and necessary. And number three, if they do not continue to spend, I want you to keep your thought on this one. If they do not continue to spend on the AI build out, they're going to lose market position to Chinese companies. They're going to lose market position to European companies, and the American counterparts cannot do that. They have to spend it. And so in my estimation, I just thought it was a really weird way to describe why the market gapped down. And especially when you go look at Meta, and especially when you go look at Microsoft, they didn't start going down, Mark, when they started talking about CapEx spending in the conference call. They started selling on the release of the numbers themselves, and they were massive beats. Microsoft beat, Google beat, Meta beat, Apple beat, Amazon beat. They were all beats, and Microsoft and Meta specifically on Wednesday night sold hard on the release of the EPS numbers, not on the conversation on the guidance. So I do not buy the nonsensical, logical reason that Wall Street and financial media is giving us regarding why the market sold. That's why I feel there's other things playing a role here. Maybe it's hesitation coming into the election. Obviously, it's a 50-50 crapshoot out there. Polls are tight. Projection market or probability markets are tight. You could see it go one way or the other. Maybe there's some of that playing alleviation, seeing a little bit of an alleviation event. But I do not buy that the market was selling based on earnings. Blended growth went from 3.6 last week up to 5.1 last week, a real good improvement. I was expecting that improvement. And honestly, I thought Mag 7 came through last week. I did not have the same opinion last quarter. I thought they came through really, really good last quarter, this quarter, though.
Yeah, no, listen, the financial media will always try to give you a logical explanation why there's a green or a red candle.
Yeah.
And sometimes they get it. and oftentimes they don't. But
It's hard. I
you
don't want to
know,
rip them. It's like
I
it's not.
do.
I know, but it's not easy to understand causation in general, let alone causation against price action. Those are some really, really complicated concepts to do. I think at Tackle Trading, we're better than most out there in the market in describing price action against the reality of what is actually occurring out there. But at the end of the day, I'll fully admit, like, could this be something going on outside of earnings this week? Could there be something going on outside of the economic condition this week? Yeah, there's a billion different variables this week, and so all I know is this: Microsoft and Meta did not sell because of CapEx spending.
No,
That's all I know.
Whatever it is, whatever they did, that's not. And I get back to my original. There isn't a negative theme that emerged out of this. There isn't something 4 days from
Not
now
on the fundamental side.
that people are like, hey, this is no, right? And that's the things I'm always focused on is like, what are the narratives driving for narrative drives for Matt overall on earnings? Quickly, letter grade at this point. We'll do a more in-depth
What was
next
that last week? Like a B minus,
B minus,
somewhere around there. I would have to say we improved last week. We're coming in right at the average beats against EPS. Revenues right at the average beats. The veracity of the beat is less than expectation. Blended growth was a concern up until last week. It's not going to achieve what it could have achieved. There's no way this earnings season gets an A, like an A minus, not even a B plus in my estimation. And so I think we're going to cap out at a very average earnings season this season.
All right, let's get into some stocks in the news. Let's talk about
that is an improve over last week, though. Last week we were kind of C plus B minus. I think it's improved to a B.
So every week in the podcast, I bring 5 stocks that interested me for whatever reason. Sometimes they're off the cuff. Oftentimes they're of course we're going to talk about that. Matt never knows what they're at, what they are. But
that's how it goes with the pod. Mark prepares all the conversations for the pod. He likes to get my natural reaction to things in the pod. I usually don't have a clue.
I do. I think it makes better content.
Like we're going to be talking about the election. I really don't know the process of the questions he's going to ask me. I'm just going to give it off the top of my head, and we're going to have a fun conversation on it.
Yeah, absolutely.
I prefer it that way on stocks in the news. And
the first one of mine, and I'm going to cheat a little bit, and put Meta and Google in the same basket. Meta had a little bit negative response. Google had a positive response post earnings. Both of them together incredibly solid. I think there's a reason communications is our highest rated sector right now.
Yeah, it's really not a close second right now. It's comms,
and so when you looked at the number, these companies are cash producing machines, right? They're cash producing.
I think you got to add Netflix there too.
And so not on my list. No. I think we brought them up a couple.
Well, they report a few weeks. I'm just talking about communications, the strength of communications.
Yeah, but specifically, talk about communications, right? Because this is one thing that in my notes this week stood out. I'm like, comms. Just clear winners on just fundamental, and then on the technical.
Well, actually on Wednesday when we were breaking down Google's report in the Traders Lounge at Tackle, and again that's something we do every single day for our pro members. But we were breaking down Google's report on Wednesday morning, and it was a really good report out of Google. And I basically said, listen, we're obviously looking for a secondary pattern here. And when you're looking at communications, this is after communications had gapped up. I said, you're not going to want to chase that, guys. Not at all. The sectors move too much. You got Meta coming up tomorrow. You don't want to chase Google. Let it develop and let it come back down. And the analysis at the time was an exhaustion gap fill on Google. And that would allow, basically communications to come back down. And I made the comment in the lounge on Wednesday morning that I said, you don't want a negative earnings out of Meta, but you want a negative reaction out of Meta because that would actually bring Google back down a little quicker. And that's exactly how it played out, Mark. Inside candle on communications. It looks like a bullish flag-based pattern with a little bit of momentum with inside candle. That would be a bullish ramen candlestick pattern. The only thing you would be looking for was a little dose of confirmation here to justify that upward movement in price. But when you're looking at that space, you might as well be looking at Google here, because that's exactly what Google did. Gapped out real strong, came right back down to the breakout channel. I know a lot of coaches at Tackler are looking pretty keenly at this Google chart right now. Meta on the other side of the equation. I don't believe Meta had a worse report than Google.
Yeah, and that's why I brought them up together.
Yeah, I just think there was, again, describing causation can be difficult, but I don't believe Meta had a worse report. In fact, I would say Meta's report was really good. Yeah, but there is a difference when you're at the top of your chart going into earnings versus where Google was at a mid-tier situation. You're going to get a little bit more love. In fact, I would say, Mark, if Meta was at its 200-day moving average, for example, you're most likely talking about a gap up momentum type situation. And so I'm not looking at the gap down and run a negative here on Meta. I would say any trade would have to have substantial development here. You got a little bit of consolidation at the top, and it's wide range consolidation. But at the end of the day, Microsoft, not Microsoft, but Meta and Google, the two big dog companies reporting on earnings out of communication. I would say Google was slightly better because they increased guidance officially. And so they did get a hat trick treatment, and they were one of the better reports of the week. So I would say Google was a standout there, but that's only because the price response was fit the fundamental side of it. Meta a little bit different, but I didn't have a negative reaction to Meta's earnings.
Super Microchip Computer is my next one, SMCI. There's been some smoke around this. Now, this was a momentum darling at the start of the year. There's been some smoke around this company for a couple months, and this week, don't have your auditor quit. And it wasn't a shocking news story. When you saw a negative news story that the auditor quit, this thing had been building for months, and for me, this has been one of those, when you see accounting, anything relating to accounting, anything, and that gets in the news cycle, don't be a hero, because maybe there's nothing to it, right? But if there is something to it, there's likely another wave, right? Like another wave, and then just horrific price response.
Well, and that also makes me not want to even look at their projections on what they're going to do for earnings coming up. But just a terrible, terrible look. Whenever understanding gaps has a little bit to do with understanding the news that creates gaps. And whenever you have a situation where you have to restate earnings, or you have some issues on that side of the equation, these are usually catastrophic gaps that don't recover in the short term. I would say their earnings environment coming up is going to be really, really, really important. This is a high flyer growth company in the AI conversation. And I listen, I'm a fundamental guy. I'm a numbers guy. And if you can't trust the numbers, it's hard to give a fundamental viewpoint on something. And that's kind of what's happening with Super Microchip Computer. If there's no fire to this smoke, Mark, you're going to be talking about an extremely undervalued stock against what the growth metrics are. But again,
you are.
That's an if A, then B. If A, there's no real fire to a healthy amount of smoke here.
Yeah, absolutely. Next one is DHI, the home builder, and I think there were, you broke down their earnings report, negative reaction, tried to get up. But home builders and a lot of things that are really tied to interest rates have some of the sloppiest charts out there, right? Not necessarily bearish.
It's hard to understand the interest rate environment next year, honestly. Until we see who's going to be the president, until we see kind of how those policies shape up, it's hard to understand exactly where the interest rate environment is going to be next year.
And so it's one of those things. It's like when we talk about yields, we oftentimes talk about them in know your basket, know your industries and sectors that are really interest rate sensitive, right? Like Google, Meta yields can go to 5%, and that probably cracks the market somewhat. But those companies not really impacted, right? And knowing that from a fundamental perspective helps you identify who overperforms, who underperforms, depending. So I just thought that was a bring up. The next one was AMD.
Real quick, can I mention something on DHI here? Real quick, it had a reversal pattern coming into it, gap down, recover. That puts it on bearish flag-based pattern analysis. It drilled a 9 on Friday, came right back down. This is a nasty look for DHI, quite frankly. It's a bad
especially
look,
those guidance. Those hits to the penny.
Yeah,
Like where you
well,
rally up and it's, yeah.
I didn't like, I had concern on the fundamental side with DHI's earnings, and so I completely agreed with the gap down scenario here. DHI is a growth stock within housing, and they are the growth stock within housing. And so if you're not going to grow, baby, grow, you got to go down. Path of least resistance is down. I thought the market was right on DHI.
Next one is AMD. Now, semiconductors, and we're going to talk about semiconductors a little more in depth, have been like, after really strong periods of time, and not counting NVIDIA, who's like, yes, it's a semiconductor, but it's NVIDIA, right? It's like in its own separate category.
They're the king of AI. Yeah, they're separate character.
But you've seen a lot of like really like choppy, larger range price movement. As a lot of companies like AMD, they'll have these spurts, right? But then it's not exactly been a easy trading environment for a lot of these semiconductor stocks. And and you mentioned this earlier in the podcast, where it's like there's nothing wrong with AMD's report. Mm-hmm. But because of where valuation is, and this is where like this holistic approach to trading, from position to investing, right? Of being aware, right? Helps you make really good decisions. I think AMD is an example of that.
It's really simple. If AMD had an 18 PE ratio, they would have doged on the report. They don't. They got 150 PE ratio. You got to impress, and they didn't. It's really as simple as that. I mean, AMD came out in line on everything. They were in line on EPS. They were in line on revenue. They were in line on forward-looking guidance. They had 122% growth on their cloud-based unit, which dwarfs what we saw out of the big dog stocks out there. But to offset that 120% growth on their cloud-based GPUs, they also had 68% reduction out of gaming units. And so it was a mixed report, but it was basically in line. But when you're priced for perfection, and that's what valuation is here. When you have a high valuation, you are priced for perfection. You have to be perfect. AMD wasn't. They came in line. It was an average report, and market has it absolutely right. If you're not going to justify your valuation, you have to go to a lower point to where you do.
And my final one is Uber, sentimental favorite of mine. Thought their earnings report was really interested. Hadn't done anything on Uber in a while. It's the most interest I had.
You're going to. I think you're going to.
Looking for a pattern. Obviously, tough pattern because they reported earnings on the day where the market wanted to sell off. Tough day to report earnings. They got caught up in that. But this is one of those classic. All right, I'm glad they reported because I didn't own it. I'm glad they reported that day because it could provide me a better entry point from a longer term position trade. It's going to take some development. But what was your take on their earnings report?
I thought the market got a few things wrong this week on earnings. I do think specifically the Meta one, I thought they got wrong. Apple gap down was to be understood. They had a $10 billion tax write-off, and then they had some concern out of China, but they had beats nonetheless as well. But I'm not sure there was one I disagreed with more than Uber.
Yeah.
And the reason I say that, Mark, is they had a really good report. I mean, nice, good revenue, good guidance, and then when you're looking at kind of the EPS handle here, they came out with a $1.20 EPS handle. Expectation was 40 cents. That is a sizable beat on EPS, and obviously one of the reasons why blended growth improved. But when you look at the EPS story over the last 3 quarters here, you go from negative 32 cents 6 months ago, 47 cents 3 months ago, and now you're at $1.20 on EPS. Now, obviously, I don't think the $1.20 happens again, but at the end of the day, that is a good projection on growth. And then when your expectation was kind of the same as you got last quarter, now obviously these companies have ways to improve EPS and whatnot. But at the end of the day, I just thought Uber had a really good report. Thought the market had it absolutely wrong. And this one, to me, I mean, when you go in and you look at the intraday analysis here, Mark, Uber was already down a good 10% like on the release of the EPS. This is something I saw on Meta. This is something I saw on Microsoft, and this is something I saw on Apple. This is something I saw on Uber. I saw pre-programmed selling programs on the release of EPS numbers, regardless of what those EPS numbers were. If they were good, if they were bad, it didn't matter. Context didn't matter. They had an immediate sell. There's things I can't prove that I know are true, right? And one of those things I cannot prove, but I just believe is true, is that Wall Street institutions, for one reason or the other, and mostly probably because the uncertainty over the election or the central bank next week, probably just wanted to alleviate some of the bullish risk going into an environment where oftentimes you want to carry a net neutral delta until you see catalyst. And so was there just some bullish alleviation this week? And that kind of stands out to me. And that's kind of why I keep going back to the volatility pocket. Now, I expect volatility to continue through the Fed on Thursday, with the bulk of that around the election. But at the end of the day, I see what the gap down this week. And again, that gap down day, Mark, was Uber, Microsoft, that was Uber, Microsoft, and Meta that day. And so all three of those did the same thing. All of them came down aggressively. I saw it as an alleviation in front of some important situations coming up next week.
Yeah, I think that's all they have. I think it's created a good opportunity. Uber's a great company, right? A special place, brand leader. Give me good.
We don't talk Lyft anymore for a reason. And back in the day, when you brought up Uber, you brought up Lyft. When was the last time anybody brought up Uber where you brought up Lyft? It's just a different conversation for an Uber.
Good. Yeah, let's get to global markets real quick. Dollar took the week off. Strong move on Friday. Yields had a tear on Friday. Came down. We had the unemployment report come out. We don't have time to go over all the economic data, but to be honest, it was kind of boring, even in an unemployment week. It's not very often you say unemployment week was boring, but it just got dwarfed by bigger things. Earnings season, election ahead of us. But you did have the unemployment come out, was a sizable miss, right? Sizable miss. Now, Fed officials had kind of telegraphed that, listen, some hurricane related, some strikes that could influence the number. The BLS talked about
specifically the two hurricanes and the Boeing strike, the workers.
And so there were things that came into play, but a really sizable miss, lowest numbers that we've had since early January 2021. And it was a miss on already lowered expectations, right? A miss on already lowered expectations. Now, the most interesting thing I saw all week happened on Thursday when you had this BS algorithmic price down. The second most interesting thing was the dollar and yields going in a straight line up all day Friday after the worst unemployment report in almost 3 years.
Quite amazing to see the dollar go up on that report. Personally,
if you'd have told me a year ago, listen, you're going to have a almost negative unemployment report and yields in the dollar will skyrocket that day, I'd have taken the other side of that bet.
I would too. If you were to tell me earlier this week that the labor market was going to come in with 12K jobs, I would have said that we were not going to see a massive sized candle on the dollar. No. But
there are dynamics at play, and once again, we'll talk about yields here in a second, but there are dynamics in play, and we've talked about kind of the causal things that have led to this point. Doesn't explain Friday though, right? It feels like the market is
context doji's Fridays can context doesn't massively engulf the previous day. And so, yes, could you have context on the, we discount the labor market this week because of the hurricanes, because of the labor strike. Yeah, okay. Mark, there's always things that happen on from an economic perspective to either improve or deteriorate the economic condition. And so I certainly think the labor side is getting a pass this week. And most likely, I do think that's election related, because if this same thing happened next month, I highly doubt we see the exact same movements on the dollar.
No.
So I do think this was a unique situation this week, but I agree with you on the overall economic side. I just did not feel navigating this week day in, day out with the community. I just didn't feel the economic data was even playing a role in the market this week. And maybe that's because I get sucked into earnings on weeks like this pretty big time.
Yeah, no, and so it's going to be, and we'll talk about yields here more in a second, but gold and silver, they did get caught up in the volatility on Thursday. You saw some of that choppiness carry through as yields climbed on Friday. We've seen this before in gold, right? We've seen pullbacks, and we've seen, I mean, 2024 has had a lot of pullbacks, right? I mean, and all of those have resolved the same way. Putting in intraday support levels, which provides the foundation for the next build up. That's what obviously we're going to be looking on gold in the coming days, coming week, isn't it?
Well, I think, yeah, on gold specifically, and we definitely need to see some stabilization in the gold mining companies that are trading more on BMAT right now than the gold itself. But I will tell you, there were 3 gold stocks report earnings this week. Obviously, we had Newmont's disastrous price response last week. You get a few more gold stocks reporting earnings this coming week. Barrick Gold #1 out of that bunch. But I'll tell you the one thing I've noticed on all of these gold stocks, Mark. They're all beating revenue easily. They're all beating EPS easily. And quite frankly, the revenue handles are all 35% year over year growth because where gold's price is. And so I think gold stocks will be, I personally think we need to see volatility settle down on the gold stocks, but there's something happens as we get into late stage earnings season, Mark. Volatility has a tendency to slow down late stage earnings season. And so, yeah, it's a pullback on gold. There's more volatility on the gold stocks than on gold, but I have zero concern over gold. But then again, I never do.
There was some chatter at the end of the week, going to crude oil real quick. Some chatter during the week that Iran would launch an attack in the coming days. I saw some of the rhetoric out this weekend from Iranian leadership. Very hostile. Is this all smoke? Is it all just bluster? We don't know, obviously, but it did, create some one of those okay, something to keep your eye on, because we started the week with de-escalation, right? We started the week, Israel had launched their attack. The market interpreted that as a de-escalationary move.
Well, personally, I question Iran's ability to counterattack what Israel can do. So, that's just me.
And it is something that if we weren't pressed on time and wanted to spend a ton of election, but we did want to bring that up. As with copper, Chinese legislature, now copper don't care about any of the things we talk about. Copper cares about one thing: China stimulus. China legislature does meet this week, see if they can appropriate some funds that markets find favorable, right? Guess what? Copper's chart's probably going to tell you, but it's a nice setup. If the market does have a positive reaction to some of those legislative measures, you're going to see it on the chart. You're going to see it on the chart, and the chart set up that 20-day moving averages came down. It will flatline in the coming days, not quite at the start of the week, maybe towards the end of the week, but nice setup for a move up if you get one here in copper, isn't it?
You're absolutely right, though. By the end of this week, that 20 would be flatline because we'd be 19 days of consolidation at that point. This pitch is getting tight here, brother. I mean, you're talking about the Chinese legislature coming online this week. I'm kind of have a feeling that copper is going to be breaking this pattern one way or the other. So close above the 20, close above 4.4 would be a behavioral change and a confirmation candle on a potential breakout.
Yeah, and finally, Bitcoin as we transition into the election, and because we're going to talk about Bitcoin first and foremost. Bitcoin's been fighting up, part of just general momentum. A lot of people attribute this to the Trump trade, things that people expect, right? As we've seen, we've talked about this in the last couple of weeks. Certain areas of the market that are seen to be potential winners, and as Trump's odds in betting markets have went up, you've seen some steam behind these trades. Now, who wins or loses, and we are not going to predict who wins or loses the presidential election, but we are going to comment on
You don't want us to look foolish?
I don't want to look foolish, and I don't want to offend people.
That's not our job to predict who wins the election.
Our job is to break down market activity.
The market is going to respond to who gets elected.
And that's a little game we're going to play for the next 20 minutes, 15 minutes, 20 minutes or so as it goes. So Goldman came out this week with some, all right, if Trump wins, we expect this area of the market to do this in the week that follows, right? So they're not predicting for all time and eternity. They're talking market reaction moves, right? Market reaction moves over the following week. And then if Harris wins, what's the market reaction move going to be, right? And so Goldman came out with this. We thought when Matt and I first saw this, we're like, oh, we're doing this as a little feature on the podcast. Creates a nice framework, because what are we looking as traders, right? We're looking not just bullish, bearish conditions. Where's the next trade? What area of the market's the next trade? What's the next short? What's the next long? Where should I be looking, right? That's why,
So basically, let me summarize, because I was getting a little confused there. Would you suggest that basically you are, because I don't know what you're doing, and I do not know what Goldman has stated. Don't get me wrong, I'm fairly familiar with kind of how Wall Street sees it from a policy perspective, but you're going to lay out what Goldman thinks will occur, and then it's our job to either agree or disagree.
It is the thumb up or thumb down on their general take.
Are they in the right frame of mind? Okay, I understand.
Are they basically, thumb up, thumb down? Are they in the basic ballpark on their analysis? We're going to start with Bitcoin, who's had a good little run. Now, this is one of the widest differences in total, expected moves. They have Bitcoin moving 8.3% to the upside if Trump wins.
Real quick, just a clarification. Is this in a week, month?
In the week that follows the election.
Okay. So basically, we're talking the short-term trends that happen after the election.
What momentum? We're not talking.
Okay, we're not talking next year, so I don't have to worry about how these policies come together. And
nope, you don't have to worry.
Short-term. Election momentum analysis.
Will the initial market momentum reaction?
I understand.
They got Bitcoin moving up 8.3% if Trump wins, which is a sizable move.
Could be a breakout.
And basically, they have a doji if Harris wins in the following week. That's Bitcoin's take. Now, you go first on this one. I'll go first on the next one.
We'll just alternate. Okay.
We'll take turns.
Yeah, I think it's really. I think it's impossible to look at Bitcoin with how Trump has really kind of talked about crypto and talked about the obviously some deregulatory situations there, but obviously Trump and Wall Street believe that he is better for the Bitcoin situation in the short term. And that's kind of where my head's at too. I think where you and I will disagree on this is I actually think Goldman's really accurate on this one. I don't see Harris as a net negative to crypto. I certainly don't see her as a benefit to crypto that Trump would be, but I don't see her as a negative. I see her as neutral against the entire conversation. I'm not even sure she truly understands the crypto conversation as well. So in that regard, I would say Goldman's probably fairly accurate on that. I would love to see how they got a doji versus 8% upward movement in price, because
we're not going to dive into that. We're going to are they in the ballpark, right?
Okay, I'm just saying the 8% doesn't make sense to me, because if you're breaking out, you're probably running away, and it's going to be more like 38%. But yeah, I would say in general, I agree with where Goldman Sachs is. I do believe it would be better under crypto, and specifically Bitcoin would have more price appreciation under Trump.
I'm going to give it a sideways, no thumbs up and down, because I do agree with you. I think the bump's bigger if Trump wins.
I think the bump's bigger too.
I think because you have good structure on the chart already. You have positive momentum.
Bitcoin could go 8% on any day.
I know.
What are we talking about?
In a week, Trump wins. I mean, it could go up 8% that day.
Maybe they were assessing the eventual retracement that occurs after that.
And Bitcoin has very few legitimate catalysts that emerge over the course of Bitcoin, ones that are easy to understand. At the start of the year, it was an easy to understand one, right? Oh, ETFs getting approved, right? IBIT. And what did we see? We saw a really large move. It's hard to get really easy to identify. I also think you probably have some volatility to the downside if Harris loses. And so I think they're in the spirit. They're right there. I just think personally the moves are going to be a little bit larger in both directions on that. All right.
So basically I agree with Goldman on this one. I just think they're a little bit light on the price.
Yeah, and I agree with the spirit of Goldman. So if I had to, I would say yes too. I think they're right on the general framework. Regional banks, if Trump, right? So regional banks, basically, and this is going to come up a couple times in Goldman
Are we
analysis.
breaking out regional versus major money center banks, or just banks in general?
They didn't do, but we're going to talk XLF here in a little bit. Okay. So we'll talk about specific sectors. Regional
so this
banks,
is specifically regional.
Yeah. Okay. Basically on a deregulationary theme, this is one of the things that's a very consensus Wall Street. Trump brings more deregulation, right? Which is, specifically good for financials. We'll talk energy here in a second. They have a pretty big gap. They have this as Trump 3.5%, Harris minus 2.2%. So a pretty big, like they're saying that there's some anticipation here in this particular area of the market. Gets us to talk things in general. I'll go first. I agree. I think there are certain areas of the market that are going to be very complex in analyzing whether Trump, Harris, what is their impact? And there's going to be certain areas, especially things that specifically benefit from deregulation. I think regional banks. I think there's a pretty wide gap here post-election. So I'm a thumbs up.
I don't think this one's difficult. I didn't think the Bitcoin one was difficult. Don't think this one's difficult. Regional banks will be beneficial off the deregulation arguments coming out of the Republicans and specifically Trump. For the very reason Elizabeth Warren won't be happy with the deregulations is why regional banks will be better performers under Trump than under Harris. So I would definitely agree with Goldman on this one.
Yeah, and just since we're talking about already the financial sector as whole, referring to the large cap,
I wouldn't have any difference of opinion.
Yeah,
on
they have that 1.6 up on Trump, down 2.8% on if Kamala Harris. One of the larger pro-Trump gaps they have. Outside of
I would love to see what they're basing that off of, because the fundamental condition of the banks right now are fairly decent. I would say they had a good earnings season. I certainly see the deregulation argument being beneficial to the banks in general, and certainly regional banks, which have had a difficult time over the last couple of years. But down aggressive, I don't know if I see that. Plus, deregulation will take some time. It's not an immediate thing. So I do agree in general with where Goldman's at, though.
No, and this is one of those, like, understand these. For example, JP Morgan's in a very tight consolidation pattern, right? If Trump wins, and it's very clear on Tuesday night that occurs, and JP Morgan breaks out, I'm going to take that side of that trade, right?
100%.
Just because, and that's what pre-prepping, and that's kind of why we're doing this little exercise right now. All right, let us get to oil. Trump 4.3% move up in oil. Harris minus 5.4%. Now, they did not do gold. If you want to do gold, we're going to have to do that independently. But they do have this massive gap up in Trump oil up, Harris oil down. Pretty sizable move. Thumbs up, thumbs down. You go first.
I'm going to disagree on this one with Goldman. When you look at oil, and again, oil is going to move on a variety of things, but when you look at oil and you're specifically talking about kind of understanding Trump's policy is drill, baby, drill, basically. We don't know what specifically that means, but we do know he wants to enhance the amount of oil production that we are pulling out of the dirt. You increase supply, you're going to decrease price, and so unless demand picks up to offset that additional supply, you're going to have a lower price threshold on crude oil. And so what I see happening is Trump's economic plan, specifically on energy, is very positive for the energy stocks, in my estimation. I'm not sure it's positive for crude oil itself. And I'm not sure that's a negative thing. But when you're talking about the deregulation we talked about with the financial stocks, that's going to have a sizable impact on the energy stocks as well. When you're talking about drill, baby, drill, and allowing them to open up the floodgates in a deregulation environment, you're talking about some fairly significant revenue handles coming out of the energy stocks. And so I would see it as a pro-energy stock move, not necessarily a pro-crude oil move, because I think some of the tariff concerns might offset that additional demand. So I see it as a wash on the crude oil, but I see it as a positive. Trump's policies on energy stocks is positive.
Yeah, there's smoking crack, financial crack on this one. Oil's going to do what oil does, and if Trump is more, it makes no sense.
Now, I think it's an easy call on the energy stocks. I don't the even
energy
know why
stock.
they would
let me give you the numbers.
Oil.
The largest gap of any sector in their predictions of any candidate is in energy. Trump 3.4%, Harris minus 4.2%. The largest gap on energy stocks. I will give it a thumbs up. I think now once again, how does that play? You remember your
I
job
don't buy
is
the
not
concern out of the Ford.
but your job is not
I don't buy that.
Worry about 3 months from now, 6 months from now. What is the market reaction in the week after, right? In the week after.
I don't know. I would say Trump. The only thing on the crude oil, and the thing about the crude oil, I don't even know why they would bring up crude oil here. But on the energy side of the equation, I am uncertain. I have concern with how energy would respond to a Harris presidency. I think that's very easy to understand how energy would respond to a Trump presidency. And so the only thing I will say on that one is I think it's very easy to agree on energy stocks up in a Trump win.
Yeah. No. Okay. Next one is nuclear. Now this one's a little bit boring because they have basically no difference at all between either candidate. They basically say both are up after the election, and they're like, because Trump has said some positive things about nuclear. Harris has said positive things about nuclear. Seems to be like one of those consensus areas.
Why was URA skyrocketing in the last 2 months?
Because we need power for AI.
Okay. So how do you assess uranium unless you assess the impact of the AI side of the equation?
Okay, fair enough.
Right. And so what were the projections again?
Both up about a 1.5% roughly.
I got it uranium up with Harris winning, and I got it down with Trump winning.
And we'll talk a little bit more in depth about that when we talk, individual
more
stocks.
so to some of the commentary that Mike Johnson has said recently, not Trump, but yeah.
All right. So let us go to where are we going to go? Well, let's do it right now. Let's do semis. This is one of the largest gaps in an individual thing, and one of the more pro. So we've talked about some areas where Goldman thinks Trump is going to do better. We tend to agree with those outside of oil, which is like we don't understand why. They have both. Well, they have both semis up under both in the week after. Trump 2.4%, but they have Harris almost 8%. That's a big move in an industry.
They're 100% accurate. They're 1,000%.
And give you a reason why, based on some of the things that we've heard out of.
Again, when you're talking about semiconductor development within the AI infrastructure, you have to be talking about in general what we are trying to do on semiconductors, and we're trying to bring back development to the United States slowly but surely over time. The one of the acts that happened out of the Biden administration that I do agree with fundamentally is the CHIPS Act, which encourages production of semiconductor manufacturing to come produce in the United States, puts regulations on Chinese imports and exports. And so it is, I cannot say this stronger. It is vitally important that we not only control semiconductor production over the next 10 years, but we dominate semiconductor production over the next 10 years. And when you're looking at kind of the tariff plan, and there's a lot of uncertainty over the tariff plan. Tariffs can be used in a positive way, and they can be used in a negative way. And so it's really difficult for my left brain to really kind of dive into the tariff side of the equation, because I just don't know specifically. The numbers have been thrown out, a lot of different numbers, and it's hard to get an understanding of what's going to occur there. But when you're talking about the CHIPS Act, when you're talking about semiconductor development, it's really not a Trump conversation, honestly. Mike Johnson came out 2 days ago and said that the Republican Congress, if they do get elected, that they are going to look to kill the CHIPS Act. And if they look to kill the CHIPS Act, you're looking at killing a massive growth argument coming out of the semiconductor side of the equation. And you can't, as a trader, as an investor, if you're thinking about this from a fundamental side of the equation, you have to price that in. You have to price that risk in. And so I believe under any scenario, semiconductors will get a bump going in after the election. I do believe that. But again, it will depend on variables here. But in general, and again, this could be a vastly different conversation 6 months from now. But based on the conversation where we're at right now, after what Mike Johnson said this previous week, you would have to believe that semiconductors would get a bigger bounce coming out of a Harris victory versus a Trump victory.
Yeah, no, and I agree as well. Listen, one thing Wall Street loves, and I know a lot of times new traders in particular get their politics tied up with their analysis because they feel so passionate about one. Wall Street loves money. They love the flow of money from Washington. Right?
This isn't an emotional conversation. This is a policy, economic numbers conversation. There's nothing to get emotional about. It's just a numbers game. And what does the market love more than anything, Mark? More than anything?
Certainty. Well, that's the
No. The market loves fiscal stimulus.
Yeah, that's the money flow. That's
the
what
market loves the money flow. Who's going to keep the money flow coming into the semiconductors when you have Mike Johnson saying that they're looking to kill the CHIPS Act and you have others looking to expand it? So it's really just a numbers game. For example, you got $100 billion coming into certain locations in the United States to build out these massive semiconductor plants. Intel's doing it. Taiwan Semiconductors doing it, Apple's doing it, Broadcom's doing it. It's really across the board. Well, why are these companies doing that? They're doing that because they're getting a lot of incentives to do that. You reduce those incentives, you're going to have less of it. So it's just a matter of supply and demand, and you have to take that into equation.
And along those lines with their semiconductor prediction, it's not going to be surprising that they see data centers benefiting more. Both have them both up. The NASDAQ.
You're not going to stop the data center build out. It's just a matter of how much are you going to feed it. And that goes like, okay, let me put it like this. If Trump wins, if Harris wins, are we going to change the amount of money that Microsoft is planning on spending in fiscal year 2025 on data center build out? The answer is no. Okay,
is the answer, right?
Is Apple going to change the amount of money they're spending on their build out? The answer is no. Is Google? Is Amazon? Is AMD? Is any of these major important companies in the semiconductor AI development? The answer is no. So it's really a matter of, how does that growth kick in? But yeah, I don't see either one of them negative against semiconductors. Again, you can't discount what Mike Johnson said about the semiconductor.
No, and I think it's one of those remove that thing in the market.
I think if you remove that, you're talking about a net wash, most likely, if you remove that. The only concern on the semiconductor side of the equation is Mike Johnson's commentary towards the CHIPS Act.
And it's not surprising that under that analysis from Goldman, they see the NASDAQ 100, they see markets up no matter who wins in the next week, but they do have tech heavy oriented S&P 500 and Harris.
They probably have growth. Again, I don't know Goldman's projections the way you do, but let me just say it off the top of my head based on this conversation. They probably have the cyclical side of the equation better under Trump, and they probably have the growth side of the equation better under Kamala.
Yeah, in fact, here, let me give you a couple stats along those lines. NASDAQ 100, Harris up is 4% versus 1.3 on Trump the week after. That's a big rally, 4% in a major index. Cyclicals versus defensives, they have cyclicals up 2% versus a slight decline on Harris. So that's exactly how they see this.
And honestly speaking, I mean, when you're talking about understanding their policy positions, and the one on semiconductors is not really an understanding of Harris's policy position. It's really, like I said, an understanding of what's the plan with the CHIPS Act. But yeah, I can't disagree with Goldman there. The way I see it, Mark, is if I see the market up either way. I do. I see the market up either way, unless we see some.
Unless we have.
Right. Unless we do see that, then you're talking about additional variables. But clean election, one way or the other. We know who wins on Tuesday, Wednesday morning. I think the market responds positively on anything that isn't a chaos. That's my base case. If we don't get chaos on Tuesday, we get a bullish move in the market. Is basically how I see it. Do you agree with that?
Yeah, no. There's only two things. One, if yields
hold on,
blow out. Okay, go ahead.
But you do agree with that, right?
Yes, I do.
Okay. So then it's a matter of, okay, which areas of the market would be better? And I do think in general, Goldman has it right. I do believe if you're talking about a market going up, you would be assessing defensive down. That's 2+2 type stuff. And then it's a question of, is cyclical the move, or is the aggressive areas?
Basically, like Goldman's saying, like, prep those growth trades if Harris wins, prep those cyclical energy
That's
trades.
well,
And I don't think that's bad advice. Yeah.
I don't think it's wrong. I think that's where the market's head is at. And I do think, again, sans chaos, market is bullish, it has a bullish move. I do believe some of the volatility we saw this week was alleviation of some of that concern due to the election. But I do believe in general, when you're looking at the environment, I do believe a Trump win would be better on the cyclical side, and I believe a Harris win would be better on the growth side. And is there context about why that? But yeah, that's where Goldman Sachs is, and that's where my head's at too.
Another easy one: tariff sensitive things. Trump down 2%. Those areas. Harris up 5%. I think that's easy. And
which one was that one?
Tariff sensitive areas of the market.
How are they defining tariffs?
Well, I didn't get that, but give me like hog, for example. Because it's not just China. When we think of tariffs, we think of China, right? Mm-hmm. Well, Europe,
that's not it. It's Europe. It's everywhere. But
Europe, like Harley Davidson, those big iconic brand names of America, they were the last go around under a Trump administration targets, right? Harley Davidson was.
Well, that's because Harley was moving a production plant over to Europe, and Trump didn't want Harley to move the production plant to Europe, and so he started yelling at Hog, and Hog kind of came off that a little bit. Didn't change it all, but at the end of the day, yeah, there was some of that, but. I think it's impossible to price in tariffs. Like I have no clue on, because we know Trump talks and negotiates through his talking sometimes.
Yep.
And a lot of times he's outlandish on things he's doing from a negotiation perspective. I'm not saying that on everything, but I am saying that on the tariff side of the equation. And so, do I believe that he wants to be aggressive on tariffs? I do. I do. But I am not convinced that that is a broad-based tariff on everything, or if he's just using that as a negotiation tactic versus, don't get me wrong, I think he wants to bring the hammer on China, but we're talking broad-based. I don't think bringing the hammer on China would have the negative economic impact that others do. I do think broad-based tariffs would be a very, very, very bad thing economically, but tariffs can be very good if used in the right way. And so, again, my general point is I think it's really, really difficult to price in tariffs because we do not know. There are way too many uncertainties on the variable side on the tariff conversation.
Yeah, got a couple more for us. Renewables, the largest gap of any two areas.
Yeah, that's
minus 5.3% under Trump and plus 12.5% under Harris.
Under which party do you want to buy your favorite solar company?
Yeah.
Usually the Democrat.
Yeah, no, and so that one's a very easy one. And whatever plays out, and we commented on this a couple podcasts ago, is like, under the Biden administration, renewables actually had terrible time. They did better under Trump and vice versa on energy over the long term. But initial market reactions,
difficult environment to understand that one though because of the pandemic. The pandemic had some pricing before the changing of the guard at the election side of it. That, man, you had some parabolic stuff going into the pandemic or during the pandemic. Obviously, that was one of them.
Yeah, I know. And the final one, which gives us a chance to talk a couple minutes about rate. And I love their call here on basically they take the most short areas of the market, and they do this a couple different ways. But we'll go the non-profitable tech versus the S&P 500 itself.
Okay, right? Broke ass bums and out of tech. Gotcha.
Some art components, but non-profitable tech.
Ultra growth tech.
Ultra growth tech. They have, under Trump, week after, minus 1.3%. Under Harris, almost a 7% jump up. And that ties specifically for me under the yield conversation, right? Whereas one of the things that has happened in recent weeks is we've seen this run up in yields. Mm-hmm. And a lot of commentators are attributing part of the move, and I think there's some legitimacy to this, to the expectation that part of the Trump trade, right? That and part of a red sweep scenario that if Trump wins,
yields are going up undeniably because some of that is the Trump trade. Yes.
And so in a situation where Harris wins, this has been a very strong move, a very strong move.
I'm surprised the market has held up as well as it has in the face of this move. Same thing with some of the commodities.
And under Harris, that gets unwound, right? That move the yield, particularly because I think you and I both have the Senate going Republican, right? The map is just particularly difficult for Democrats, even if you get other success in other areas this year.
I think it's tight, but I personally have the Republicans 51-49.
Yeah, and so if the Senate goes
51-47 with two Dems caucusing.
Yeah, if Republic Senate, Harris presidency, that's going to alleviate, because the big bear bond case driving yields up, been irresponsible fiscal spending. Now, we both believe, no matter who's elected, there's going to be a lot of spending. Right?
Politicians, I'm sorry, this is not a Democrat-Republican conversation. Both parties spend money, both parties go into debt, and that has to change. It absolutely has to change. But a Republican Senate will corral the Democrat president who wants to put out an aggressive fiscal spending plan. And a Republican Senate will throw a whole hefty dose of cold water on that.
And so those areas that are interest rate sensitive under that scenario, you can see them having a very good week. 7% moves, very good. Now, in some of those most shorted stocks, that might be one day, like under that scenario. But if Trump did get the red sweep, and this is probably the most interesting variable for me post-election, if Trump wins and you get a red sweep, what do bond yields do? I'm almost positive they crash if Harris wins, right? The move's been too strong.
I would see buy the rumor, sell the news event on that one.
And that very well may be how it plays out.
In general, I would say that you would have to, if Trump wins, the most likely scenario in my estimation is it is a red sweep. Republicans take the House, Republicans take the Senate, Republicans take the presidency. In that scenario, you have to respect the tariff conversation. And because you have to respect the tariff conversation and a little bit, and this is just an economic conversation, but tariffs and mass deportation they are inflationary based. The Fed knows that. The Fed would have to come off how aggressive they are on the projections on interest rates going into 25 and going into 26. You would have to have the market price that in, Mark. You would have to. And so I don't think they're wrong there either. The only thing I'm really surprised at is I only had a couple disagreements with where.
Yeah, the most surprising thing is how much you agree with Goldman, because
I never agree with. Actually, I'll tell you this: I have long held the belief Goldman Sachs has the best traders and the best analysis on the marketplace. They're also the second most devilish bank.
Yeah, I was going to say they don't always share the good stuff with the public.
Exactly. But no, listen, I think from a market perspective, I think Goldman Sachs has this one pretty accurate, quite frankly. I disagree on some of the veracity of the movements, obviously, but in general, I think when you looked at the entire conversation of this space versus that space and this space versus that space, I think it's as easy to understand when we were talking cyclical versus aggressive. And I think it's really as simple as that. I think Trump would be better on the cyclical side of the equation, and I think Kamala would be better on the growth side of the equation. It's hard to see. Let me put it like this: I have a hard time seeing the big old bad bear playing a role here.
For me, yields have to go parabolic, which probably actually doesn't happen until after the Fed meets, right? Mm-hmm. I think you could even see a reprieve after the election, no matter what. And then what does the Fed do 2 days later? Because they moved their meeting back 2 weeks. But the most likely scenario, you'd have to see some civil unrest, chaos ensue. Otherwise,
honestly, the more I think about Goldman Sachs, that's about as chalk of analysis as it gets out there. But I also think it's right. I also think it's accurate. I think there's some areas of the market that will obviously beneficiary. Other areas of the market won't. For example, an easy call for me on if Harris wins, take a look at, say, your aerospace and defense companies. I think you would probably do better under a Harris camp versus a Trump camp based on kind of the expectation from a foreign policy perspective. Outside of that, I think you're pretty much chalk across the board, and I think Goldman kind of had that.
Well, listen, a fun little exercise. Let's wrap up, Matt.
I hate agreeing with Goldman Sachs.
You did it. You did it. Deal with it. You're gonna have to deal with that all weekend. Feel dirty about it. Feel dirty about it. But anyways, close us up. Send us out.
Yeah, hopefully you guys enjoyed the podcast here today. I know I did, and I always do. Best way to support the podcast from us at Tackle Trading is to certainly tell somebody about that podcast, but also to give a nice little like and share and help us spread the good word of trading justice and tackle trading at that as well. If you're interested in coming and joining us at Tackle Trading as a free trial member of the pro membership of Tackle Trading, where you can get access to that amazing newsletter, the Traders Report with the best picks of the week, I think there's 5 different videos to help you understand both the application side as well as the educational side in our newsletter and Traders Report. You can come hang out in the Traders Lounge, which is our live program we do every single day, navigating the financial markets with our community. And you know, the best time I have in the Traders Lounge, Mark, is not when we're talking about Google's report and what they did and what the technical side of it is. It's the 30 minutes at the end of the Traders Lounge, which we call team time, where anybody in our community can ask us any question, a trading question, an investing question, an educational question, trade management. I can't tell you the amount of awesome conversations we have every single day on trades, investments, just with our community. We call that team time in the Traders Lounge. Our community is an amazing community. It's a full stop shop from both an application and an educational perspective. We are the #1 rated educational company in America, according to Trustpilot, because we do whatever we can to help our students, both on the education and the application. So if you want to be a part of that amazing community, put the education in application, come over to tackletrading.com, hit the link in the description below, and become a free trial member and ultimately a member of Tackle Trading. And my last thought is on the election side of the equation. A lot of emotions around this election, obviously, but this too will pass. And if your individual does not win at the end of the day, Mark, we all are Americans. We got some really, really cool things to build in America over the next few years. So let's get the job done. But totally understand the emotion around this one. I just hope everybody votes and everybody supports their candidate of choice with pride. And at the end of the day, realize that we are all Americans and we all love each other and we all have so much more in common than what divides us. And that's my last thought.
Yeah, well said, brother. Have a great week, everyone.
Later, team.